Today's topic, loan scams, and it starts right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome back. Let's talk loan scams.
All right, let's talk about that.
Yes, and the reason I want to talk about it is because the people who tend to get scammed are the people who are most vulnerable. Yep. So people with bad credit, new immigrants, older people.
Don't understand how the internet works, all that sort of stuff. Yep.
And they're the ones who are more likely to get caught. So let's go through some of the popular scams. And the first couple are maybe not scams, but I'm going to put them in the scam category.
Right.
And that is really high interest loans.
You just want to talk about payday loans.
Yes, because
get me going.
It's 2020 and we have not addressed payday loans yet in 2020. So the big problem with payday loans, of course, is wickedly expensive.
And there's no way to get off the treadmill. Once you get in with these guys, they take your money every paycheck, and then you got to borrow again, and you just keep doing it over and over and over again.
And in Ontario, I believe the rules are still they can charge $15 on every 100 you borrow.
Correct.
Which is not 15%, as we've mentioned many times before. If you're getting a loan every 2 weeks, that's really 390%. So,
something ridiculous.
So that's something I just wanted to throw that in there.
Yeah, just to get me going.
We haven't talked about that yet this year.
Well, but let's talk about high interest in general then. So let's put the payday loans behind us. The next tier of those guys is their high-interest installment loans. Let me highlight those to people, too. So payday loan is a short-term. You get it for 2 weeks. You repay it. The installment loans, you're paying, well, most of them are 49% interest, and you pay them back over 3 to 6 months. That's just insane.
Yeah, and they can be up to 60% because that's what the criminal code says, and that is a massive amount of interest.
Right.
And so why do people get those kind of loans then?
Well, so the first is they get sucked into these payday loans, and then it's, well, we can help you relieve the pressure by getting one of our bigger installment loans. And just about everyone we see that has an installment loan has gone back to get a subsequent payday loan from the same people.
Yeah, and the reason they're getting the loans in the first place, you and I talked about this on our year-end predictions podcast, is expenses.
Right.
People's expenses to live are a lot higher than, they're going up faster than what their income is.
The old joke was you run out of money before you run out of month, right?
Yeah, and that's a very common thing. Yep. With, rent's going up, groceries, transportation costs, whatever, my pay isn't going up as much. Yep. How do I make ends meet? Well, I resort to payday loans, and then I resort to these other types of things. Yep. And so it's something to be avoided. Okay, so that's high interest loans. Yep. Let's go on to some, less things that perhaps our listeners and viewers are not as familiar with. First one I got on my list here, advance fee loans.
Oh, yeah, these things are great. And years ago, when people read newspapers, you used to go in the classified section and they'd be these little ads that say, bad credit, don't have problems getting a debt or getting a loan, guaranteed we'll get you a loan. $500 fee. You pay the $500 fee. They call you a week later and say, I'm sorry, we weren't able to get you a loan, and they refund you $100 for your trouble. They never actually tried to get you a loan in the first place. So this worked great with the newspapers. Nobody understood them, and it was this little sideline. Now it's getting to be big business. So you see these ads, they pop up on your screen, or if you're still reading a newspaper, on the newspaper, and it's all the same. It's bad credit, we can help you get a loan, but you got to pay us a fee first.
And so how do you protect yourself from this?
Well, so the first time anybody ever asks you for a fee before they actually do anything should be a huge red warning flag. You just say, this doesn't make any sense. Why would I pay you until I know I've actually purchased the service from you, that I'm going to get this thing?
Yeah, and it's same in our business. If someone says we can settle your debts, but you got to pay a fee up front, then that's a big
get
warning
up and
flag.
Leave the room.
Because it's we do not charge upfront fees because, number one, it's unethical, and number two, it's illegal. Now, I want to be clear here, though, because if I go to a mortgage broker, they're going to charge me a fee.
Right.
That's how they make their money. And in some cases, it's actually a good idea to go to a mortgage broker because they can shop the market. Instead of you just going to one or two lenders, they can go to more.
If you're going to the mortgage broker to try and get the best rate because you've got options, it's fabulous. If you're going to the mortgage broker because every other legitimate lender turned you around, it's a bad idea. That's the simple test.
And so how is it okay to pay a mortgage broker but not these other advanced loan fee guys?
Well, and the mortgage broker shouldn't be looking for a fee from you until they're actually confident they can secure a mortgage for you.
And that's the key.
That's the big difference,
It's not an advance fee. Yep. They are getting their fee out of the mortgage proceeds. So if they don't get you the mortgage, you're not paying them anything. It's a fee for success. And in most cases, well, in all cases, it's built into the cost of the mortgage. Right. So instead of borrowing $400,000, you're borrowing $405,000 or whatever it is, and their fee comes out. And some of that may be paid by the lender anyways. Loan companies in Ontario are required to be licensed by the Financial Securities Commission of Ontario. So you can certainly check to see if someone's registered.
Right.
If Joe with the little ad in the newspaper or on the internet isn't registered, then there may be a warning sign there.
If Joe is based out of Indonesia and he's doing it all online, that's probably a good sign not to be dealing with Joe. Might be something to worry about too. Yep. And it is illegal in Ontario to request an upfront fee prior to obtaining a loan. Right.
So when you go to the bank, they don't charge you an upfront fee.
When you go to a payday loan company, you don't pay them $20 to borrow the money.
Yeah. So if even the payday loan companies aren't doing it, then you know it's an issue. Okay. Right. Enough preamble. Let's get to the good stuff, because the one I really want to talk about is, and there's no real definition of this, but I call them savings loans.
Yeah. This is a relatively new thing, and they're preying on people's fear of credit ratings.
That's what these are for. So they're either called savings loans or they're called credit repair loans or whatever.
Right.
And so why don't you walk through how they actually work, what happens?
Well, so the idea is these people providing this service will tell you that, well, we're registered with the credit bureau, so you're going to borrow from us. We're going to create a savings account, and we're going to report all of your payments as service on this debt, so it's going to help rebuild your credit.
Yeah, and so I'm going to have you walk through an example, and this is an actual example.
This is somebody who came in to see us.
And we're not going to mention names of companies and all the rest of it. But
although if you do a Google search, there was a lot of this in the news.
You'll be able to figure it out, yes.
Right.
Erica Laney from Global News has done a lot of reporting on this if you want to point yourself in a certain direction. So the pitch is we're going to loan you money, and at the end of the term, you will actually have money. So that's why it's called a savings loan. So unlike other loans where we give you the money up front, we're actually going to give you the money at the end, but it will report to the credit bureau, so your credit rating will improve. That's the pitch.
That's the whole idea.
And I kind of get that, because 5 years from now I want to buy a house, I want to buy a car, I need to get my credit rating up, and I don't qualify for anything because my credit is bad, so how else can I do it? So I go to a place like this, and the example we've got, it was a payment of $55 biweekly over 3 years.
$110 a month.
So walk me through what this $1,750 loan cost.
So it's important to remember that number, folks, because at the end of the day, they're telling you that you're going to walk away with $1,750. And so every month, again, you're going to pay that, $55 every 2 weeks. And how long are you going to be paying that?
3 years, so that would come to $4,297.67.
Right. So is anybody concerned yet?
I'm concerned, because right off the top of my head, $4,000 sounds a lot bigger than $1,750.
Right. It doesn't make any sense. And here's where the money goes. There's a $550 setup fee.
Cool.
So to get into the program, we got to charge you a fee. There's interest on the actual debt. Now this is $676 for 3 years worth of interest on money. That's not a bad number. The problem is it's not the only cost, and it's really, they're just throwing it in there because they can.
Yeah, and the interest rate, according to their documents, the APR is 39%, and you're not borrowing $1,750. You're borrowing $1,750 plus the $550 setup fee.
Plus?
Well, tell me about the plus.
All right, so there's also a loan protection fee.
A loan protection fee.
Because if you can't make your payments, then they'll cover the payments for you. And then there's a credit monitoring fee. So we can actually make sure that this is being reported properly on your credit, which is the service that we're selling you in the first place.
And what kind of bucks are we talking?
So the $682. So again, the total cost for all these administrative fees plus the interest, $2,513. How much money are you getting at the end of this?
$1,750.
So,
which is where we're getting the $4,000 from. So,
and it's your $1,750.
Yeah, right? They're loaning you my own money.
Yep.
So I pay $550 as a setup fee, $600 in interest, $600 for a loan protection fee, $600, almost $700 for credit monitoring. So I've ended up paying $2,500 on my $1,750 loan. Right. That's where the $4,000.
And so over 3 years, they basically got you paying, call it $90 a month to rebuild your credit.
And so our number one objection to this is the cost.
Right. Well, it's idiotic.
It's idiotic. Yeah, and I agree. I think it is idiotic. But, okay, I'm a guy who I already walked you through the scenario. I don't have good credit.
Right.
I want to rebuild my credit or build it up. These people are offering to give me a loan, and I realize I got to pay more because I have lousy credit, and at least at the end of the day, I'll have something to show for it.
Yep.
Why are you objecting to this?
Well, so I'll keep it within a 3-year timeline, and I'm going to give you an alternative. Right? Let's say you get yourself a secured credit card. Now, secured credit cards, there's 2 ways. You pay an upfront fee to get the card with a certain limit, or you put money in a savings account and they give you a credit card issued with the same limit. Either one of these solutions will work, but let's do the one that has higher costs. So let's say you apply to Capital One or Home Trust. Those are the 2 big companies that do this online for a secured Visa with a $300 limit, $500 limit.
Yeah, let's say let's say $500.
Okay, so a $500 limit, they're going to charge you at today's rates $150 setup fee. So we've got to include that as one of our costs.
Well, and in fact, it's become more competitive such that some of them don't have a setup fee anymore.
Okay.
They're going to charge you a high interest rate
if you don't pay your balance.
But I'm not worried about that because I'm going to pay my balance.
Right.
My issue is I don't have $500 or $1,000 to give Home Trust or Capital One or any other secured credit card company.
Right.
Whereas these guys, I don't have to have any money up front.
Yep. So that we're going to list that as an advantage for these guys, savings loans, and then we're going to make the comparison. So we were making a $110 payment to these guys every month. So I'm telling you, you get that secured credit card and you use it to make $100 worth of purchases every month and you pay it off.
Well, so I guess if I have to save up a $500 deposit, it's going to take me, let's see, 5 months.
But the $500 deposit's only required for the cards where you're putting the money on deposit. Capital One and Home Trust don't require you to do that.
Yeah, we're talking secured cards here.
Yep.
You're right. If it's an unsecured card, then obviously you don't. So
but there is a Capital One and Home Trust has a secured card where you pay a setup fee.
Yeah, their typical one, and there's there's many different ones, and they do change what. I mean, the new offerings come out all the time. But I guess to keep the example really simple. If it's a $500 security deposit, I need $500.
Okay.
And in this example, I'm paying $55 every 2 weeks for my savings loan. So in less than 5 months, I can save up that security deposit.
That's true too.
And so from a timing point of view, okay, I get this loan right away. So I guess it starts reporting to the credit bureau right away.
Right.
But if I waited almost 5 months, I could have my secured credit card, which would also be reporting to the credit bureau.
Yep.
So, and the big advantage is I didn't have to pay $2,500 in this cost of borrowing.
Well, and your cash flow is the same. In fact, your cash flow with the secured card, if you put $100 worth of purchases on it every month to pay it off, that's money you are already spending. So you're not trying to come up with new money here to pay off this loan. It's part of your monthly living expenses, so it's more manageable.
Yeah, well, because I'm paying it anyways. And
there's no interest because you're paying the balance every month.
Yep.
And you're building history. The big thing with restoring your credit is it takes time because you're building history.
And so the argument in favor of these savings loans is they rebuild your credit. That's the whole reason people are doing it. And you're right. I can get the loan right away, so the history starts right away.
Yep.
But there's a few problems with this. Other than the obvious one,
$2,513
for the money you got to pay.
Yep.
The first problem is, yes, they are reporting it to the credit bureau, as they say, and because you're paying $687 for credit monitoring, you'll, I guess, get a copy of your credit report every month, and so you'll know.
Right.
But you're getting a loan from an alternative lender, not a big bank.
Yep.
And I don't know exactly how the credit scoring system works because it's a secret.
But your bet.
But my bet is a loan from a traditional bank has more weight than a loan from an alternative lender or a payday lender or one of the less mainstream types of lenders. You're borrowing $1,750, so the amount is relatively small.
Well, it's insufficient to do what you really want to do, right?
Insufficient. That's a good way to put it. Because, in order to be rebuilding your credit, you want to have trade lines on there that are $2,000, $3,000, something like that.
Right.
So it's a small number. And once the loan is paid off, it's paid off.
You're done.
You're done. So with a secured credit card, it's on your credit report. It's a revolving credit.
Yep.
It's there every month, month after month after month. with a loan, it's there every month while you're making the payments, but then once it's paid off, it shows as paid,
Right.
and gradually fades into the background.
Well, it becomes static, right? So everything they report after it's paid off is it's paid off.
Yep. And so, okay, if it was paid off a couple of months ago, that probably still has some impact on your credit score. But if it was paid off a year ago or 2 years ago or 3 years ago, it's in the past now and therefore has no particular value.
Well, and we have no evidence that when the banks are looking at approving you for credit, after you've had some kind of difficulties in the past, that they put any value on these things at all.
Yeah, we have no evidence one way or the other. We also do know for a fact that the score, your credit score that you get from Equifax or TransUnion is not exactly the same score that the bank is using.
Right.
Because they've got their own internal systems. And whether you get to borrow or not is not just based on your score, it's based on a whole bunch of other things, job stability and so on and so forth. So, okay, let's go back to practical advice here. And you've already kind of started touching on this. So I want to rebuild my credit. A savings loan seems like a good way to do it, but it's wickedly expensive.
Right.
What are my options?
All right. Well, so keep this in mind. It took you a while to destroy your credit. Like, it takes time for bad things to happen. It takes time to rehabilitate yourself. So always think about that. It's history that you're trying to establish. So you want some kind of time to pass. And so the first most important thing is save.
Cash.
Cash is king. Always has been.
Yep. Yeah, and for a number of reasons. Number one, if I've got cash in the bank and I need to buy a new pair of boots, I just use the cash in the bank. There's no interest.
Right.
And obviously, I can use that cash as the security deposit on a secured credit card, for example. So I agree. Number one, and cash doesn't report on your credit report.
Right.
But this isn't about your credit report. This is about you.
And we've done this in the past, too. Maybe it's time to review with people how credit reports work. We're not going to do it today, but there are too many people that are just too terrified of these damn credit reporting agencies.
Yeah, and common sense should always be your guide.
Correct.
Having cash in my pocket is better than having a really good credit score.
Yep.
If it's a mutually exclusive decision. Obviously, it always isn't. But yes, cash is king. You can use that cash then for your emergency fund, for buying stuff, for a deposit on a secured card. And so if I get a secured credit card and my credit starts to improve, then what?
All right. Well, so then you can apply for an unsecured line of credit, which would be a regular credit card or an unsecured line of credit at the bank. What you're doing is you're building a history. So you start with that foundation, which is whatever type of credit you got first. A secured credit card is most likely. And then you add to that the next level, which would be a regular or unsecured credit card. Perhaps during this time you get a car loan too. And if your goal is to get a mortgage or some other thing, your objective is to build a history. Again, month by month, we make it better. Brick by brick, we build the wall.
Yeah, and that's really your point. This does not have to all happen on one day.
And it can't. There is no way to improve your credit perfectly overnight. Yeah. In fact, if you suddenly won the lottery and you paid off all your debts, the next month, okay, all your debts are gone. And so now what are you going to do to improve your credit? Mm-hmm. I mean, it's all about transactional relationships. You get a bill every month, you pay it. We should talk about cell phone accounts and how badly they impact people.
Mm-hmm. Yeah, if you don't pay, that's going to make your credit score look worse.
Which is crazy because you think about it, the phone companies are not actually advancing you credit. They're billing you every month for a service. But if you don't pay for that service every month, you take a pretty good hit in your credit bureau.
Which comes back to your first point that cash is king. Well, I'm a little bit behind this month. Oh, wait a minute, I got cash in the bank. I can pay my cell phone. That's going to have a much better impact on not screwing up my credit than getting some kind of savings loan or doing something else. So, Okay, so there's a bunch of practical ways to improve your credit without getting into one of these savings loans. Now, the final type of loan I want to talk about, again, it's not really a scam, but it's
a scam.
It's a scam. It is a scam.
We've done the math every way from Tuesday on this stuff.
And this is a special type of loan that applies to people who are in a consumer proposal.
Right.
And as our regular viewers and listeners will know, a consumer proposal, that's one of the things we do. It's a legislated settlement where we go to your creditors, make a deal. Okay, you owe $50,000, you're going to pay $300 a month for 5 years, pay it off.
Right.
The consumer proposal stays on your credit report for a maximum of 6 years from when you started or 3 years from when you pay it off, whichever is shorter. And Equifax, TransUnion do them slightly differently, but that's the gist of it. So the thought behind a consumer proposal loan is I get the proposal up and running.
Yep.
And so now let's say there's $15,000 left owing on it. I go to one of these companies that does these things. I borrow the $15,000, pay off the proposal. So now that 3-year clock can start.
Yep.
So I'm 3 years closer to it being off my credit report. And it's a brand new loan, which improves my credit.
Right.
What's not to like about this scenario?
Well, so first and foremost, there's no interest in a consumer proposal. So there aren't any fees associated with it other than what your monthly payment is. It's all built in. So you've taken something where you've reduced your debt because you had financial problems to something where there's no new interest charges, there's a manageable monthly payment, and now you're turning it back into some sort of debt with interest on it. And the interest isn't going to be cheap.
No, these things are in the 30 to 60% range, just like, you're getting a loan from an alternative lender. You have no security. Your credit is not great because you're in the middle of a proposal. So
Right.
It's probably at its absolute low point.
Mm-hmm.
So they're not lending you this money at 3% interest.
Right.
It's going to be a lot more than that. So if it was a $15,000 loan in my example,
Mm-hmm.
and if the interest rate was 30%, then the first year you're paying
$4,500 in interest.
$4,500 in interest. And of course, if it's on a declining basis, it'll be a little bit less. But
Yep.
if it's a 3 to 5 year loan,
And it will be.
you could very easily be paying $15,000 in interest on your $15,000 loan. Could you be?
Certainly. 30% interest, yeah, you probably double the cost of the loan in 3 years.
So this is a pretty simple decision, is it not? I can borrow $15,000, pay off my proposal quickly. It's going to cost me $30,000 to discharge the debt.
Right.
But I pick up 3 years of time on my credit report.
Mm-hmm.
And I have a reporting loan. So is that worth an extra $15,000?
And it shouldn't be to anybody. I mean, again, my suggestion would be save enough money for a secured credit card, get a secured credit card as quickly as you can after you start the proposal, and start rebuilding your credit that way.
And pay off the proposal quicker then.
Well, and that would certainly be another solution.
Because if you're getting a $15,000 loan, and let's just make up a scenario here where there was 4 years left on my proposal and
Yep.
I end up getting a $15,000 loan and I'm going to pay it off in 4 years. Well, the payment on the loan has to be more than what you were paying on the proposal.
Because there's interest on
there's
it.
interest.
Yep.
And if the interest is $3,000 or $4,000 a year,
It's another $250 a month.
so if I could afford that loan payment, I could certainly afford to pay the proposal off quicker.
Right.
In which case, okay, so instead of
And my advice to that person would be get the money in a savings account and then annually just decide I'm going to reduce the proposal by some amount. Because again, cash is king. You don't have access to credit. You're better off to have it in your hands in a savings account than to be prepaying a proposal loan or to pay the proposal off quicker.
Yeah, and our advice to everyone who comes to see us is once the proposal's up and running, the first thing is savings. Got to have some cash.
Get a nest egg.
Yeah, get a nest egg, an emergency fund, a cushion, whatever you want to call it. You don't have access to credit cards, so when you do need a new pair of boots, you got to have the cash sitting there. And then I agree, as time goes on, okay, I've built up, I want to have $1,000 in there, and I built up 2,000. Okay, take 1,000 and throw it against it. So mathematically, you're much better off paying the proposal yourself and not incurring all those interests. Throw all that money on it.
Right.
Now, isn't it better for us if the person gets a proposal loan and pays the proposal off quicker?
Well, so it would accelerate how quickly the creditors get their money back, and that's how we get our fees. So I guess, we get paid faster.
So we're giving this advice not because it's better for us,
right?
Because actually it isn't. It's better off for us if you pay the proposal off quicker. We get paid the same amount whether it takes you 2 years or 5 years, but it accelerates the cash flow. Mm-hmm. But we don't want to see people solving debt problems with debt.
Right. That's the shortest answer. All debt is bad. Let's just leave it at that.
We're not big fans of it, and people are going to tweet. Well, they won't tweet you because they can't find you on Twitter, but they're going to tweet at me, and they're going to say, "Well, there's nothing
what the hell was he talking about?
A mortgage is good because look, my house went up in value." Yeah, if you can afford it, if there's a defined end to it, no problem. But the kind of debts we're talking about today are wickedly high interest,
right,
and just don't make any sense.
And the only people getting these types of loans are the ones that are the most vulnerable. It's not the guy with perfect credit doesn't have to worry about a savings loan to rehabilitate their credit rating or an instant or an installment loan on the internet or a payday loan. This is for the folks that are already in trouble.
Yeah, and the frustrating thing about the consumer proposal payoff loans is people think they're doing the right thing.
Right.
You know, it's like, wow, that does make sense. The sales pitch sounds good. I'm going to get this paid off quicker. I'm going to improve my credit quicker. But they don't actually sit down and do the math to figure out
what's it going to cost.
Yeah, by using those interest payments to pay off the proposal quicker, well, you're probably only saving maybe a year or two, maybe only a year on your credit report, and you've paid all that extra money, which you could have used for down payments, security deposits, all the rest of it. So not a fan.
Right.
We're not a fan. Okay, so let's close the show with final advice. We've hammered this point a few times, and that is save money, cash is king.
Right. Don't borrow if you don't need to.
And whether you're saving in an RSP, a TFSA, a savings account, don't get bogged down in the details. Save money. Okay, so that's point number one. What other advice do you have?
Okay. Sorry. Don't ever borrow if you don't need to borrow. I mean, you've got to decide when something is a need versus a want. Impulse purchases are the worst ones possible. If you have to put it on your credit card and you can't pay the credit card off at the end of the month, maybe you shouldn't be making a purchase.
Yeah, and I understand the concept of I'm getting a job. It's the next town over. I have to have a car.
Yep.
You know, I'm not going to buy some $500 junker because it's not going to last. I'm going to get a car loan. My wages are more than enough to pay for it. Okay. I mean, I'm not going to object to that.
You've made a decision.
Yeah, you've done the math and thought about it. But getting a loan for the purpose of getting money to save?
Right. Well, that doesn't make any sense whatsoever.
That's just totally ridiculous. So, okay, save money. Don't borrow if you don't need to. What else?
Read the fine print. Make sure you understand exactly what you are committing to and what it's going to cost you. Because that's the way most of these things succeed. They convince you that the payment is reasonable, and you don't actually look at the cost.
That is a key point.
Yep.
It's only $55 every paycheck.
Right. Everybody can do that.
And yeah, you know what? I can do $55. And in fact, I was paying more than that, and so that you know, this is it sounds really good. So I guess that leads to the final, most obvious point. Then,
do the math.
Do the math.
Understand exactly what it is it's going to cost you.
Yeah, because it's not the $55 a month that matters, or biweekly. It's the $55 times 78 payments or whatever it is that ends up being $4,000, and that's what kills you. In fact, somebody on Twitter once said to me, I think it was our year-end prediction show, they said, you didn't pump your book. You forgot to put, and I go, oh my goodness. How
could I not do that?
How did I do that? So I will throw in the pitch for Straight Talk on Your Money online and in stores everywhere. And one of the comments I make in the book is that it is not the monthly payment that is the issue.
Right.
It's the total.
It's the cost.
You got to look at the total cost, because that's what's going to myth number 5. The most important number is the monthly payment. Nope. The monthly payment is almost irrelevant. It is the total that you're paying that gets you into trouble.
Yep.
So there you go. Any other final words of advice on these different loan scams?
Yeah, I mean, a little common sense, folks. If you need to borrow and you've approached the banks and the banks have said no, then you need to reconsider whether or not you need to borrow. If you're looking at any of these alternate lenders, any of these second tier, third tier, fourth tier, internet-based people, probably you should be talking to somebody else.
Yes, if the problem is you've got a whole lot of debt, then talking to a licensed insolvency trustee would probably be a much better idea than digging yourself deeper and deeper into debt.
Right.
So common sense, save money, do the math, make sure you understand what you're signing and what you're paying.
There you go.
Ted, thanks very much for being here. That is our show for today, Loan Scams. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.